Well, September historically has been the worst month of the year, not only in terms of average price change, which has been a decline on average, but also it has fallen more frequently than it has risen. So it has been down 55% of the time. So, with us still being in negative territory as we embark on the final week of September, in many ways, that's not a surprise. October, surprisingly, is a better than average month in terms of price change and frequency of advance, but it sort of comes in like a check sign, meaning it enters the month, it declines, and then closes higher than where we entered. But the volatility is very high. In fact, the S&P 500 volatility in October is 36% higher than the average volatility for the remaining 11 months of the year. The volatility is traditional in October, and the decline that we've seen in September is not out of the ordinary. The real question is it over yet? The S&P has had its ninth longest run between declines of 5% or more since World War II. Expectations were on the 20th that we would end up eclipsing that minus 5% threshold and, in a sense, reset the dials. Yet we only fell a total of 4% from the September 2nd high through September 21st. So we're still in that very long period without a meaningful decline, which we believe will need to be registered before this advance really can move forward in earnest. Well, the margin debt, margin calls, they do tend up exacerbating market declines because when the prices fall, then these investors have margin calls that need to be filled. And if they can't fill them, then they have to sell the shares, which ends up becoming a cascading effect, sort of like a snowballing effect. So that could end up pushing the market lower more quickly. So we'll have to wait to see what happens. But at the same time, margin debt does tend to peak toward market tops. It tends to be a coincident indicator, not necessarily a leading indicator. Well, actually, those groups that tend to fall the most in a market decline are those that had done the best leading up to that decline, because they're the ones that have the most profit that investors want to protect. So communication services, real estate, and technology are those that are furthest above their 200-day moving average. Once the decline has occurred, however, the question is, where do we go from here? Well, our belief is we're not going to be falling into a new bear market. It will be a pullback or a correction, and that investors probably will be gravitating toward the value side of the equation. Interestingly, but energy and financials fall into that value side of the equation. It's going to take many, many years before fossil fuels no longer become the fuel of choice. Yes, you have many companies that are investigating non-fossil fuel alternatives, but it's going to take a while before they become mainstream. So with oil prices expect to average around $75 a barrel in 2022, our expectation is that there could be some good upside potential for energy stocks in the coming year. At the same time, if the Fed has already told us that they will not be raising short-term rates for the next year, but because inflation is creeping higher, because the Fed will be taking their foot off the gas by allowing a tapering to take place, that could end up widening the yield curve, which would be beneficial to financials. So the answer to that debate, in my opinion, is both could end up being outperformers. If we do go through this decline fairly soon, then I would say yes, those investors with long time frames will want to look at the tech sector, because that's the sector that has very strong and consistent growth projections. And the tech sector has tended to do fairly well, even in a rising inflationary environment over the past 30 years. So I would tend to say you don't want to give up on technology. It probably could be a neutral to an underweight in the near term. But once we do go through a price reset, then I think investors will find many opportunities in the tech sector.